What's up, folks? Kenneth here, 100 Years of Wealth, Stream Home Loan, back in it. Here's some good content for you that hopefully brings value to you and actually some monetary value. So I'm gonna drop a quick video about IRS code 121. IRS code 121. This is how you avoid paying capital gains taxes on a sale of a real estate or on a sale of a piece of property, right? So I was in the scenario recently where me and my wife were considering selling an investment property that we have. And as we were starting to think about selling it, we started doing the math on what we would have to pay as far as capital gains tax on the profit that we've made on it, right? So really quickly, a little backstory. We bought this house in 2016 for $415,000 here in Los Angeles. 2016, I feel like the market was recovering from the dips that had happened in 2008, 2009, 2010. Values were starting to creep up a little bit. But they inched their way back up to where in South LA, close to Crenshaw, Slauson area, we were able to buy a house for $415,000. At that time, we thought that was a good price, but we still felt like that the market was starting to creep up. And we were doing a comparison of our rent, where we were renting at, compared to what the mortgage payment would be on that house. And we're like, hey, it makes sense. We can pretty much keep our mortgage payment the same as our rent, get a mortgage payment the same as our rent and move into this property. We knew the area already because previous to the apartment we were living at, anyone that's familiar in Los Angeles, Park La Brea Apartments over there by the Grove, we're living there. Our rent payment was about $2,600 a month. We did the math on the mortgage for a $415,000 property. The mortgage was going to be roughly the same, like literally almost exactly the same. While on the other hand, our apartment rent was going to go up about $120 every single year because of the way rent control works in Los Angeles. They're able to go up about 3 to 4%. So based on our numbers, it was like every year we're going to be seeing an increase of $120 roughly, and that increase is going to incrementally go a little bit higher. So the smart thing for us to do was, hey, let's figure out where we can find a property. Obviously, we weren't able to find a single family residence by the Grove for an equivalent rent payment or equivalent to our rent payment. So we went back to an area that we were more familiar with, or an area that, I won't say familiar, but an area that had lower prices for housing, right? So looked in South LA. I always felt confident about South LA, seeing that it's a very nice area. Been dealing with certain stigmas of our own gang culture and things like that, but like when you're living there, you kind of understand it a little differently, and you understand, okay, this is where activity is going on. This is where things aren't really happening like that. It's not as hood as everyone might expect. This is a good area to buy in. And then we looked at the geographic location, seeing that South Los Angeles is really positioned well between downtown LA and the beach, right? You're close to the west side. You can easily get to Melrose and Hollywood. You're not far from Inglewood, SoFi Stadium. And you start to look at that and you're like, wow, this is probably one of the better positioned areas of the city. On top of that, there's a lot of nice craftsman style homes. You got View Park and Windsor Hills close to South LA, which are really high value properties, really dope style, and View Park is even an actual historic area. So considering all of that, I'm like, hey, this is a smart area to get into at the price range that they're selling for in 2016. So that's all the thinking that went into our decision to buy in that area, and really thinking like, hey, most likely you're going to start to see property values creep up in that area and get to a point where it's more comparable to other areas with similar houses. It's really about like the stigma of the area kind of changing, and then you start to have more people from outside the area understand the value, start trying to move in there because it's less expensive than other areas in the city. Thus, you start to have value start to creep up pretty rapidly, right? So in 2016, we bought the property for $415,000. At this time, we're looking at, hey, you know what? If we were to sell this property, what could we get right now? In today's market, properties in that area. We've seen properties with similar square footage, style, and space on the outside list for above $1 million. The differences on those properties, some of them might have like a fully renovated bathroom while our bathroom still needs to be renovated. Some of them might be staging the property with full furniture, which really makes a big difference for a lot of buyers, because some buyers can really see a property and say, okay, I can see what I can do here, I can see what I can do there, I can see the little fixes that I need to do. They have like a good vision and a good imagination on what the property can be, while other people, it takes a property being like fully, completely renovated, fully staged, nice furniture in there, just so that they can say, okay, wow, this property is worth what they're trying to sell. So understanding that, I understood, okay, we're not staging this property. We have tenants that are in there right now, and we're not gonna be able to stage the property with new furniture unless we really start to do some extra moving things around. So we're like, okay, that's not really an option, and we're not gonna be able to do like a full renovation on the bathroom before we try to sell. So what can we get right now based on its current condition? Considering obviously the things that are being sold in the area and the price that they're selling for. After that, we realized that we could probably sell the property for somewhere around the $900,000 to $950,000 mark, right? So when we realized that, we're like, okay, wow, that's good. That's a great return on our investment. We obviously would like to just keep every property that we come across and hold it forever and always receive rental income and then blah, 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 blah. But sometimes it does make sense to realize your investment. And for us, the calculation that came into that was capital gains taxes, or one of the things that we had to consider was capital gains taxes. So capital gains taxes basically is the tax on the gain that you made from pretty much any sort of transaction, whether it's the sale of a car, whether it's the sale of a business, the sale of a antique, a sale of clothing that you sell online, or whatever the case is. It's the difference between what you already have put into it and the amount that you're able to sell it for. So if in this scenario we're able to sell that property for, let's say, $950, and we paid $415 for it, the difference would be $510,000, right? So we were looking at that number, we're like, okay, wow, that's a great gain on our investment, right? Like, we definitely bought at the right time. This is, likely a good time to sell, even though, it's always great to hold on to an asset, but sometimes, like I said, it's beneficial to you, your family, your current wealth to realize that investment, right? So as we started doing the math, we're like, wait a minute, are we gonna get hit with capital gains tax? We don't currently live there anymore. It's an investment property. Are we gonna get hit with this big tax? And we're like, yeah, I guess we are. It's an investment property. It isn't our primary residence. We are likely gonna get hit with a massive tax. The tax being, I think, double check in your state, and then also just double check what I'm saying, but this is from my recollection. I think it was like 20% for federal taxes on the gain, and then like 10% or something around there for state taxes. So we're looking at a tax on that $510,000 of around 30%. That quickly dampened our spirits related to selling that property. It made it very unattractive, and it made it to where we were like, fucking Uncle Sam, like, we're gonna have to give up $120,000, $130,000, whatever the exact number was, to sell this property. So now it's like, damn, like, do we just hold on to it forever and just kind of borrow against it and keep the property and never actually sell it to avoid those capital gains tax? It was really like a feeling of like, man, we're kind of screwed, one way or the other. Either we realize our investment now and walk away with a good chunk, but still give a massive chunk to the IRS, or we hold on to the property and essentially never sell it and just rent it out, make small increments back, and use it as like a leverage the property, borrow against it when needed, pay off other debt, keep the cash flow coming in. You know what I mean? Like, but eventually, even if you paid off your whole mortgage on that property, let's say that eventually you're seeing $4,000 or $5,000 a month times 12 months, that's $60K for the year. In the best case scenario, we weren't seeing that much rent right now, but we're just saying in the future, it keeps going up. That $60K that you receive each month or each year, you're going to be paying capital gains tax on that. So there's really no way to avoid getting taxed. You have to be strategic. There is one way to avoid paying tax, right? So this is what I found out. That section, and there's many videos online about this, but there's code section 121 of the IRS codes that speaks about capital gains related to the sale of a primary residence. What we did not know was that property, because in the last 5 years, we lived in it for at least 2 of the last 5 years, it is still considered our primary residence for tax purposes. That to us was so wonderful to hear. That way, if you are selling a property, you are allowed up to $250,000 in equity gain that per person that wouldn't be taxed. So in this scenario, 2 people, me and my wife, up to $250,000 per person that you can receive and not be taxed on. That's $500K total for, combined. And I think the difference was there was like another $10,000 or so if we were to sell at that $950 price, that we would actually be taxed on, right? So that's massive difference. That makes things towards, okay, we'll pay a small tax on that amount above $500K that we realize, but the remaining portion, because it is our primary residence for tax purposes, and we are allotted that $250 per person, all that is tax-free income that we get to realize, right? You're only able to do this one time in a 5-year period. So it's not like you can kind of like move into one property, stay there for a little while, and then go to, there's obviously loopholes that the IRS understands and has accounted for. But if this is your property that you've lived in for at least 2 years out of the last 5 years, you can gain up to $500,000 for 2 people or $250,000 for 1 person and not have to pay any taxes on that. So that is the scenario. I hope that gave you some information. Like and subscribe, and check out some of the other videos. All geared towards giving you information that hopefully can increase your net worth, increase your ability to make money, and just increase your savviness when it comes to all things financial. Like and subscribe, comment, leave a message, send me a DM, do whatever, but hope all is well with you. 100 years of wealth. Thanks.